Welcome everyone! In this video, I will give an overview of credit risk management in financial institutions with a focus on commercial loans at CDFIs, Community Development Finance institutions whose focus is on serving underserved communities by traditional banks. I will first give an overview of credit risk management, and then I will go into details about compliance, risk assessment, and risk mitigation. So let's start with credit risk management. In order to earn a return, we need to take risk. Credit risk is the chance that we might not be repaid in full or in part when we lend. And credit risk management is keeping the level of risk we take appropriate to the level of return we want to achieve. It involves evaluation, monitoring, minimization, and control of risk of default of loans given to borrowers. As OCC states, loan losses has been the most important cause of institution failures, and the current environment has made credit risk management even more important for lenders. And credit risk management applies to the whole loan cycle. It spans from underwriting to monitoring to workouts, and in some unfortunate circumstances, liquidation of collateral. The first step in the process is underwriting. During underwriting, risk is analyzed by getting to know the borrower, evaluating the 5 C's of credit, and understanding their market. And the risk is controlled through loan structuring. Once the loan is disbursed, loan servicing makes sure payments are collected and any delinquencies are addressed. And studies show that financial institutions that have good working relationships with their customers reduce loan defaults. The closer the lender is to its borrowers, the better they understand their business, and it also affects the willingness of the client to default. Now let's talk about compliance. Policies and procedures are designed to regulate all major decisions and actions of an organization. Their content and the organization's compliance are monitored by the board and potentially by external entities such as regulators, auditors, credit enhancers, and funders, depending on how the CDFI is organized, as a community development bank, credit union, loan fund, or a microfinance institution. NCUA is a regulator for federal credit unions, and they perform annual visits to assess credit risk management activities and compliance with policies and procedures. Auditors can be internal or external as a third party. An audit provides credibility to financial statements, and it can also help improve an organization's internal controls and systems. Auditors evaluate the credit risk and whether adequate loan loss reserves are established in line with the credit risk. FDIC and NCUA's regulations require annual audits for insured depository institutions with $500 million or more in total assets. Credit enhancers can be private or government grants or programs such as USD and SBA guarantee programs, New Markets Tax Credit, NSP, which is Neighborhood Stabilization Program. Funders also care about how an organization manages its credit risk. Some CDFIs receive funding from federal government CDFI Fund Program, which has a rating system called CARS. It's a comprehensive third-party assessment of a CDFI's impact and financial strength. What they do is they review past performance, current financial position, and risk factors in the future. And similar to regulators, their on-site examination includes an analysis of financial and programmatic information, an extensive review of loan files and risk management systems, and then in-depth interviews with management and board members. Next, we're going to talk about risk assessment, which is very important in risk management, as what doesn't get measured doesn't get managed. Risk assessment activities can be categorized as monitoring, analysis, and reporting. Typical monitoring activities are annual financial statement collection, which can be audits, tax returns, or internal financial statements. The frequency and the extent of the financial statements typically varies by loan size and complexity depending on the portfolio composition. In addition to financial statements, sector-based information could be evaluated periodically. Examples are vacancy rates for commercial real estate projects, academic performance for charter schools, or energy production reports for solar farms. Site visits help complement the financial statement analysis as it helps the credit analysts get the story behind the numbers and also get insights into the business outlook. It also helps lenders review condition of the collateral and local market trends and help assess if a reevaluation of the collateral is needed if there are substantial changes observed. Loan performance is monitored throughout the life of the loan, and necessary actions are taken in regards to risk assessment, such as rating downgrades with delinquency or distress mods. The last component of monitoring is collateral valuation. In addition to site visits, natural disasters, economic changes, or decrease in credit quality can trigger revaluation of collateral or discount rates applied. The next category of risk assessment is analysis. This includes ongoing as well as ad hoc analysis that supplement the regular ones. Loan-level risk ratings are completed periodically, generally quarterly, which helps determine expected losses. Risk ratings are converted into probability of default, and loss given default is the uncovered portion of loan balance after liquidating collateral. When you multiply probability of default by loss given default, you get expected losses. This is calculated at loan level and can be used for risk-based loan pricing at loan origination, and can be aggregated into portfolio level and used as the basis for loan loss reserves. Some ad hoc analysis might include strategic analysis, such as impact on profitability of different products, or it could be specific sector analysis or stress testing expected losses. I will go into more detail of these analyses in subsequent videos. One thing I would like to highlight is that having accurate and accessible data is key to perform these analyses, which leads to more informed decision making that hopefully results in reduced credit risk. The last risk assessment activity is reporting. At loan level, annual loan review report includes and analyzes information gathered during monitoring, including financial statements, site visits, sector-based indicators, loan performance, and further analysis including covenant compliance, risk rating, and collateral valuation. This narrative style report can be prepared for larger loans and for high-risk loans for smaller ones. Credit risk reporting can be simpler for smaller and lower risk loans, such as maybe risk rating only or financial statement analysis only. At portfolio level, common reports are concentration risk by industry and or geography, rating distribution and migration, loan performance including modifications, troubled debt restructuring, delinquency, and charge-off. Historical incidence and loss severity are typically used in allowance for loan loss reserve modeling. Now let's talk about how risk assessment leads to risk mitigation to decrease the probability and effects of default. Risk assessment during underwriting helps figure out where the risk and mitigants are and how the loan can be structured to decrease the risk of default. Underwriting involves assumptions which could be realized or not. Things can change after the loan is dispersed, and communication is key to mitigate risk down the line. Financial covenants are used to set expectations from the borrower. These are typically used to either keep the company's financial condition from deteriorating from the levels reported at the time of the loan approval, or improving certain financial measures to a more acceptable level. Some examples are minimum debt service coverage ratio or liquidity requirements. Technical assistance can be provided directly or indirectly throughout the loan process. Loan application makes borrowers think through their business plan and help them reduce risk. Other forms of technical assistance include sharing best practices among borrowers, trainings, or tutorials. Workouts also are an opportunity to provide technical assistance. Loan modifications are another form of risk mitigation. The purpose can be guarantor release or change. It could be refinance. It could be collateral release, subordination or substitution, maturity extension, or interest-only period extension. Collection activities include contacting borrowers who are delinquent, which could lead to workouts. Troubled debt restructuring, or TDR, is when there's financial distress and a concession given to the borrower. It could involve deferring or reducing payments, maturity extension, or forbearance of default. If none of these strategies discussed works, then liquidation is the last step in minimizing losses. It can involve pre-sale or foreclosure of collateral and pursuing personal and government guarantees if there are any. This concludes the video, and in the subsequent videos I will go into more detail about the concepts discussed, starting with risk ratings. Thank you for listening.